This video looks at how you go about choosing a stock to invest in from the stock market. It's risky stuff, but it's possible to make mega returns. We're also going to look at a strategy for starting off with investing in stocks without taking loads of risk. Hi, I'm Marcus De Silva and welcome to the Steps to Investing YouTube show, helping you beat low interest rates with simple tutorials and strategies that get you investing in the stock markets and earning a better return. Please like the video and subscribe to the channel and turn on notifications for the latest videos. Also send us an email if you've any questions. If we don't know the answer, we have a whole network of experts that can lend a hand. So, out of all the investments we talk about on Steps to Investing, individual shares are amongst the most risky. But of course, with risk comes potentially big rewards. Now, here's an example, okay? Apple released its first iPod in 2001 for $399. Now, if instead of buying an iPod, you bought $399 worth of Apple shares, then today your holding would be worth $158,500. It shows you when you get it right, which admittedly is quite hard, the rewards can be exceptional. Now, I've worked with professional fund managers for years, and I can tell you that picking winning stocks is tough, which is why professional investors go through a lot of training and frequently admit that they never stop learning how to invest. But you can make some inroads as private investors, and you can have some success if you build a good strategy and stock picking process and then stick to it. The goal is to find financially sound businesses that have a higher likelihood of success. Today, we're going to have a look at where you begin, which documents are invaluable for understanding everything you need to about a business, the top 4 areas of a company's finances that you need to look at, and then, if you stick around to the end, I'll share with you a strategy to begin with stock picking without having to take too much risk and face losing all those pennies. All right, let's start at the beginning with a quick definition of shares. Just as a reminder, shares simply represent little pieces of ownership of a business. They're also called stocks and equities quite a bit in the industry. So just think of equity from Dragon's Den, right? Shares entitle you to a share in the profits when they are distributed. These are known as dividends, but they also give you the right to vote on important decisions. Returns come in the form of the dividends, but also from rising share prices if the business becomes more valuable. And this will happen when it does particularly well, sells lots of products or services, and becomes increasingly more profitable. Now, the really important thing to remember is investing in individual company shares is risky business. Whilst you can become fabulously wealthy if you pick a winner, as I mentioned in my intro with Apple, the flip side is taking a fairly hefty chunk of risk. History is littered with failed or dodgy businesses, or those that just go through long periods of being poorly managed. And this will cost you big if you own the shares in those businesses, as the value can drop sharply and substantially. Ultimately, if a business goes bankrupt and it fails, the price of its shares will go to zero. All right, so starting off, broadly, investing in a stock involves knowing as much as you possibly can about the things that affect its value, which could mean big, broad factors such as economic growth or changing interest rates in a particular market, all the way down to much more granular company-specific stuff like the levels of its debt it has on its books or its profitability. Now let's start with the big ones. First, think about the market that you want to be in and how strong that market is right now. Do you want to be in developed markets like the US or the UK, which will have more stable economics generally, such as interest rates or level of employment? Or do you want to be in the exciting emerging markets like China or India, which are riskier, but where strong economic growth can lead to lots of opportunities? Next, think about the business sector you want to be in. Some sectors, for example, utilities or healthcare, are a bit more resilient to the cycles that economies naturally go through, expanding and contracting. Whereas others, let's say financials or industrials, are a bit more exposed to those cycles. Third, think about the size of the business you want to be in. Smaller firms, such as those that you might see on the UK's alternative investment market, also called AIM, are riskier and generally more exposed to the domestic market, but come with potentially higher rewards when compared to the larger blue chip stocks of the FTSE 100, which tend to be a bit more global. All right, getting down to picking the shares. Marketplace has been identified. Now you need to thoroughly research the companies. Now, plenty of information can be found in the places that you buy shares, such as the share dealing services or trading platforms. But there's also loads of other websites too, which are really useful, such as Yahoo Finance, MarketWatch, Morningstar. They're all free. Or you could go to places like Stockopedia, Motley Fool and ShareScope for more in-depth paid-for analysis. Now, according to our investment expert, Laith Califf, who's head of investment analysis at platform AJ Bell, the company's reports and accounts are a treasure trove of information, he says. These are formal documents that contain things like broad descriptions of a company's industry and its competitors, as well as all the audited financial statements that help you understand how the business makes money. If you sign up through the London Stock Exchange, you can opt to receive whichever listed company's accounts you want. Now, Laith suggests 4 areas to look at in the reports, so we're going to go through those 4 now. And don't forget, sign up to the channel to be notified of the latest uploads. Okay, number 1, the company's profits. Clearly you want a business's profits to be juicy and fat. And the key figure to look at is the earnings per share figure, or EPS. And there are 2 main ways to look at this. First, have a look at how the EPS figure trends over a number of years. You probably want it to be a smooth upward line which shows consistently rising profits. The other way is to divide the share price by the EPS figure, which gives you the price to earnings ratio, the PE ratio. This is an important figure. It indicates how expensive the business is, which can then be compared to previous years or even other competitors, other sectors, and so on. Okay, number 2, profit margins. It's also worth looking at the profit margin because low margins will give the business less wiggle room for error and trading boo-boos before slipping into a loss, whereas a larger margin will mean the business is better placed to weather any storms that it might have in its market and still remain profitable. Compare margins within an industry though, as some industries like tech or healthcare will be more profitable than others, let's say supermarkets or construction. Number 3, dividends. Dividends, which are a company's distributed profits, are really important, especially if you're looking for income, as they're a very positive sign of financial discipline. You'd like these to be incrementally growing each year, but also for a company to be careful that it isn't over distributing its profits and not keeping enough back for investments in new projects. The way to look at this is by comparing the dividend per share to the earnings per share, as you wouldn't want this to be too high a percentage, as that might imply that a dividend isn't sustainable. Okay, number 4, the last one. Debt. It's a classic area to look at as it shows you how leveraged a business is. The key figure is net debt. If this is growing sharply, it could be a warning sign that debt levels are unmanageable. Now, stick with me, but if you divide the net debt figure by a figure called EBITDA, which stands for earnings before interest, tax, depreciation, and amortization, which is basically a measure of profit, then you get an idea of how many years it would take for a company to pay off all of its debt at its current levels of profitability. Generally, a net debt to EBITDA ratio of less than 2 is considered quite healthy, and a ratio above 3 starts to raise eyebrows. All right, final tip, how you get started with stock picking. Now, as I said, the risks involved in holding just a few stocks can be pretty exorbitant. So the way to reduce these is through diversification. So this involves investing in lots of different markets, also company sizes and sectors. But the problem is it can take time to properly diversify a portfolio and invest in a wide range of companies. On average, professional funds hold anything from between 20 and 100 or even more stocks, right? A good starting point is to hold a core of diversified funds that will keep your returns chugging along towards your long-term goals. Now, these could be cheap trackers and ETFs or slightly more expensive actively managed funds and investment trusts. Then you can start adding to your core holdings small satellite positions in individual stocks to start testing the water and get comfortable with taking more risk. Over time, you can expand these positions and opt to bat for bigger returns with more of those satellites. Okay, in summary, number 1, investing in individual stocks is way riskier than funds, but could lead to big returns. Number 2, start from the top and think about broad factors that affect a business. Number 3, then go to the report and accounts and sift through all of its finances. Number 4, to start slowly, invest in both funds for diversification and stocks for fun. Thanks very much for watching. Please leave any comments below the video and we will respond to you. There's always our website for more resources. We'll see you next time.